I'm Ron DeLegge with ETF Guide, and margin of safety is a time-tested strategy for de-risking your investments. In a minute, we're going to discuss the history and the context of how it fits into your investment portfolio. But before we do that, I want you to understand that margin of safety is a fundamental cornerstone of investment management and investment strategies. And it's one of three cornerstones. You've got asset allocation, diversification, and then, of course, margin of safety right there alongside of it. Now, it's also important to understand that asset allocation and diversification are not substitutes for your portfolio's margin of safety. It's crucial that you comprehend this point because a lot of investors have asset allocation, they have diversification, but they don't have an adequate cushion or margin of safety. And investors who stubbornly attempt to de-risk their portfolio with asset allocation and diversification alone will be badly disappointed. A much better approach is to combine all three of these strategies, not one of three, not two of three, but all three strategies right alongside each other. Now, in this slide, this kind of explains to you the reason why we combine margin of safety with asset allocation and diversification. It's because margin of safety does something that those other two strategies cannot do. For example, it gives you zero volatility, it gives you liquidity, and it gives you 100% principal protection. And so this is a very fundamental understanding of how margin of safety differs from asset allocation and diversification. Those strategies can hedge you partially against volatility, but they can't hedge you 100% against volatility, and they can't protect your principal 100% and give you 100% liquidity at all times like your margin of safety. So in other words, what I'm saying is that margin of safety does something completely different than asset allocation and diversification. So in that sense, it's complementary. So let's talk about the history of margin of safety and give you a little bit of a history lesson. The concept was invented and originally developed in the 40s by Benjamin Graham and David Dodd, the founders of modern-day value investing. Now, surviving the 1929 stock market crash and then the subsequent Great Depression taught them both valuable lessons about the importance of safety of capital. Now, although their idea was applied to selecting individual stocks at undervalued prices, Dodd and Graham's principles about safety are applicable to managing an entire portfolio of investments. Not just how an investor picks the individual securities, but again, how the entire portfolio is managed. And as a side point and a homework assignment for those of our viewers watching this, I want you to Google Benjamin Graham's name, and I want you also to Google, while you type in his name, the word mentor. And I want you to tell me in the comment section below what pops up on your screen. So again, go to Google, type in Benjamin Graham mentor, and tell me what pops up on your screen. Put it in the comment section below. So in the context of you, me, the individual investor, our margin of safety represents the capital or money that we absolutely cannot afford to risk to unrecoverable market losses. That money gets set aside from your core and your non-core portfolio, and it's illustrated in this next slide. It's invested in fixed accounts with principal protection, zero volatility, liquidity, and again, the prudent investor, just some of you wondering, well, what's the timing on this? When's the best time to do it? Well, the prudent investor doesn't wait until a financial meltdown or stock market crash to establish an adequate margin of safety. They have forethought and they do it before. It's like fire insurance, right? When is the best time to acquire the insurance? Is it when the house is on fire? Or maybe it's after the house is burned to the ground. What do you think? Well, of course, it's before the event. It's before the crisis. And so it's the same way with your investments. You don't wait for a crisis. You don't, like right now, with this banking crisis, everyone's scrambling for safety and they can't find it. Like, come on, people. You should have known this in advance. And so, and these are sophisticated people, by the way, that have been losing their tail, people like Mark Cuban, Sharon Stone is another one who got caught up in this, and Peter Thiel. So there are people, very bright people, that are still not getting this margin of safety concept. They're not applying it in their own investments, and they're paying dearly for it. So in summary, this is what I've done at ETF Guide. I've built a margin of safety tool to help you do a couple of things. Number one, it's going to help you calculate the target level for your safety percentage of your portfolio. Number two, it's going to help you monitor that target safety amount with updated calculations. And number three, it provides you a path for implementation. Because what good is calculating your portfolio's margin of safety without implementing it? I mean, what's the point? There is no point. And so we got to have you do all three, right? The three steps are calculate, implement, and then, of course, monitor your portfolio's margin of safety. And so that does it for today's program. I've got more margin of safety videos for you. They're coming. So I hope you're ready. And we're going to educate you about the importance of having this fundamental aspect of your portfolio built in right alongside asset allocation and diversification. So stay tuned. Hit the subscribe button and post your comments below if you've been enjoying our programs like this one, as well as Portfolio Makeover and ETF Battles. I'm Ron DeLegge. We'll see you next time.